once you become clear that the true fundamental value of an ounce of gold at this moment, before more money printing, is somewhere between $38,000 and $40,000, and the true fundamental value of an ounce of silver before they do anything else is somewhere between $1,800 and $2,000. Where you see the pain on my face is there's so much off-balance sheet garbage that happens and so many derivative contracts which are leveraged that even if I tell you 38,000 or I tell you 135,000, that is very conservative. Very conservative. And when you look at the level of movements in places like Venezuela, who've already had 6 overnight revaluations, I'm pretty sure the first overnight revaluation went up 3,500%. So I can tell you it's 38,000 now, but does that mean that's what's going to be? I don't know.
Gold prices have more than doubled since late 2023, repeatedly hitting all-time highs in a sustained rally. The precious metal outperformed major equity benchmarks in 2025 with an eye-popping 65% return, its strongest single year since 1979, then built on those gains in early 2026. A historic rally combined with extreme volatility might appear to weaken the case for investing in gold at this stage. Yet the outlook for 2026 remains strongly bullish, with a revised price target of $6,000 to $6,300 per ounce. The recent pullback could offer a strategic entry point for long-term investors, especially as demand grows for diversification away from the dollar, protection against geopolitical risk, and insurance against unexpected inflation. Lynette Zang is a market strategist and precious metals expert who focuses on the true fundamental value of gold and silver. Using global debt figures, Lynette Zang states that calculation points to much higher gold prices. Based on U.S. debt alone, she estimates a potential gold and silver revaluation level closer to $135,000 and $2,000 per ounce, respectively. In her view, as debt and synthetic gold claims continue to grow, the pressure for a major gold revaluation increases because, unlike fiat currency, gold cannot be created at will. Moreover, Lynette explains that it's extremely difficult to accurately measure how much paper gold suppresses the physical gold price. While the BIS publishes derivative data, the real scale of global gold manipulation is hidden in the shadows. If you're ready for unfiltered truth and sharp market analysis, hit that subscribe button. Let's explore the latest insights from Lynette Zang's recent interview.
Can we quantify how much paper gold affects the price of physical gold? Does paper gold suppress the physical price? And if so, can we tell how much? It's really hard to tell because it's almost impossible to find out all of the derivative contracts of gold. I mean, I can look, the Bank for International Settlements does publish that on a quarterly basis. So anybody can go in there and pull some of that data. But when I first discovered them, or not first discovered them, I'll say the last time that I was able to see what I think of is probably better data, that's 62,000 or 64,000, whatever it was. I think it was 62,000. I think I misspoke earlier. But 62,000 ounces for one. After that, up to that point, central banks had really not been much in the derivative market. You know, a little bit in the foreign exchange market to manage their currencies, but that's just one currency against another. Totally another story, but they didn't really dabble too much in the derivatives. After 2008, they are fully in it now. And so what they did was they changed how they account for everything. So I would say, Rupert, that it's probably impossible to get complete good data on all of the derivative gold that has been created and then how that suppresses the price other than understanding how to get the fundamental value. Because this is debt money, right? We've already established that this is a note, this is debt money. So how do we even know what the true value of an ounce of gold is in terms of, in this country, dollars? It's simple. You take all of the debt and you divide it by all of the gold, because gold, there's a finite amount. Debt, there's an infinite amount, and then that gives you a number. So when I do it on a global basis, take into account all the world's debt presuming that's even right, because there's so much off balance sheet stuff that's going on, that comes out to, I think the most current one I did was about $38,000 in change. However, when I looked at it just for the US, because remember, every single central bank has a gold revaluation account. If they're going to take care of their debt, then it has to be individually. And so in the US, that number was something like $135,000 for 1 ounce of gold. But nope, I do not know. I do not have, I mean, I can show you how much they're reporting in the FDIC, the Office of the Comptroller of the Currency, the OCC, runs a quarterly report on derivatives in the FDIC insured banks. And if you go in there and you scroll, you can find lots of things, but one of the things that you'll find is precious metals derivatives, which are to the moon. However, they had changed accounting policies or practices a few years ago. To be more honest, no, there's no way to know. It's too hidden. It's too hidden. But we do know what the fundamental value is. And those, where you see the pain on my face is there's so much off balance sheet garbage that happens and so many derivative contracts which are leveraged that even if I tell you 38,000 or I tell you 135,000, that is very conservative. Very conservative. And when you look at the level of movements in places like Venezuela, who have already had 6 overnight revaluations, I'm pretty sure the first overnight revaluation went up 3,500%. So I can tell you it's 38,000 now, but does that mean that's what's going to be? I don't know, because it's on a 1-to-1, and the more debt they grow and the more derivatives they grow, the higher that number goes. So for us to see a first overnight revaluation, now I'll blow your socks off. $3 trillion? I mean, it could happen. Why? Because there's no value in those trillions. It doesn't cost anything to create this stuff. Nothing. It takes labor and energy and wealth to create this. It costs nothing to create this. And going into the digital system, it'll cost even less. So that's the true value of the currency. And the Federal Reserve even shows you that in the FRED, the Federal Reserve Education Department, Purchasing Power of the Consumer Dollar. Take a look for yourself. Look at how they have a big fat zero on the bottom of the left-hand axis. That's because that's how much that's worth.
Volatility in silver is starting to ease, with prices consolidating in the elevated $80 an ounce range. While the market is still well below last month's all-time highs, the long-term uptrend remains well supported by robust fundamentals, according to the latest report from the Silver Institute. In its latest research note, the Institute said that silver's biggest fundamental support comes from the ongoing supply and demand imbalance, which is expected to continue through 2026, marking a 6th consecutive annual market deficit. In the analysis, Lynette Zang shares a personal example of a sterling silver belt she bought months earlier for around $300. After weighing it at 10.7 ounces, she realized its metal value alone had nearly doubled in fiat terms, proof that it's not metals rising but currencies losing purchasing power. Lynette reiterates her broader thesis that gold and silver are money at their core. Based on her debt-to-gold calculation, she estimates gold's fundamental revaluation level up to $40,000 per ounce, and silver between $1,800 and $2,000 per ounce before additional money creation. Let's jump into the interview.
I can't give you a whole lot of guarantees, but I can guarantee that I will show up and I will do the work. And I can also guarantee that at some point, all assets go to their true fundamental value. I did a little experiment because I bought this when I was in Malaysia and Cambodia, and it's a sterling silver belt, right? And the workmanship on it is really beautiful. And happened to wear it yesterday for the first time, and I thought to myself, I bought this. When did I go? It was like the end of September, so before the big run on the spot markets. And at that time, I think I paid like, I don't know, $300, $325, something like that for the belt. So I happened to wear it yesterday, and I thought, I wonder how much this thing weighs, because I never weighed it. But I did, and it weighs 10.7 ounces. That means that what took me, $300 or $325 to buy in September is now just the monetary value of it worth double what I paid for it in terms of fiat, without this extra layer of protection, because it's a collectible, isn't it? I want you to keep this in mind. I always have my forks and all of that over here, because gold and silver in any form is monetary at its base. So once you become clear that the true fundamental value of an ounce of gold at this moment, before more money printing, is somewhere between $38,000 and $40,000, and the true fundamental value of an ounce of silver before they do anything else is somewhere between $1,800 and $2,000, then if I paid $350 for it, what difference did it make? Right? Just like my necklace that you see me wear that I bought back in 1987 when I first moved here for $350. And the latest appraisal was $6,500. Just the gold content weight. I turned it off. Give me a 0. Just the gold content weight of that is 1.6 ounces. Do you see what I'm saying? It's not that gold is going up. It's the value of the dollar going down. And gold and silver in any form will hold your purchasing power intact. It's the way that you hold it and the variety of ways that you can hold it. So the strategy isn't switching mints or crossing borders. It's stepping into forms of metals that give you insulation, privacy, and control, no matter what jurisdiction you're standing in. So now I'm going to go to, I need the slides up, because Daniel Mastroco last week said, I'm curious what the 5 gold confiscations in the U.S. government has done. Google doesn't provide the results. Maybe you can make a short video on that. And that's what I'm doing. So these are, and actually when I went back and I kind of looked at the definition, again, I'm wrong. Right? It's not 5 times, it's 7 times. And I'm also not just looking at the overt confiscations, but the currency revaluations. And I didn't have those in my list. The two, oh, did I say this? The 2 that happened in 1973, the first one in January, which was just under 10% revaluation, and the one in February that was just over a 10% revaluation. They did it in measured strokes so that you and I, well, those of us that were around then, didn't really notice it too much, except I can tell you, I remember the inflation that was happening during that period of time a lot, something about 45%. So I think it just missed the hyperinflation definition of 50%. But here they are. In 1812, contracts that were invalidated and the mints were closed. In the 1860s, the government went further by physically confiscating gold and voiding private contracts. In 33, citizens were forced to surrender their gold, and in 34, the government revalued it overnight, capturing 40% of the public's wealth with a single stroke. And guess what? Based on all the money that they created up to 33, they should have done it to 42.22, but they knew that the public wouldn't be able to tolerate it. So we started out, even after the revaluations, in a deficit. In 1971, convertibility for other governments was cut off entirely. That was a Bretton Woods default. And, I never really thought about it as a confiscation, but it was totally a confiscation, because foreign governments that were holding their gold here with the promise that they could exchange dollars for gold anytime they wanted, that was the default, right? Because we said, nope, you can't do it anymore, which means that the U.S. confiscated the global gold. And by 73, that gold was revalued twice more. So understand this, the pattern is unmistakable, because let me show you this. I thought, well, here's just a list of all the times just since, well, I think we go to 1812, the number of times and the different countries that have done overt and reasonably covert confiscations. You know, the pattern, right, during wars, depression, currency instability, the government protects itself first. Right? They flip-flopped the Constitution, where it used to be that the individual was the head, and then the states were supposed to support the individual rights, and then the federal government was supposed to support the states who were supposed to support the individual rights. That's been flip-flopped. And you need to understand that it's not always through overt seizures, sometimes through revaluation, for bans, for forced sales, inflation, taxation. At the end, the result is the same. Citizens lose their purchasing power if they believe the lies. And we know, how many times can you be lied to and you do not know the truth? History doesn't repeat perfectly, but it rhymes. And every rhyme points to the same truth. In a crisis, gold moves, governments try to move faster, because whoever holds the gold holds control.
Rising geopolitical risks and trade tensions, inflation concerns, a potentially weaker dollar, and the risk of a meaningful correction in stretched equity markets should all continue to support gold in 2026. While new highs are likely to be followed by pullbacks and periods of range-bound trading, we believe this gold bull market still has several years to run. Based on Lynette Zang prediction, how should investors prepare for the possibility of a major gold and silver revaluation in the near future? Let us know what you think in the comments. If this video brought you any knowledge, give it a like, subscribe, and ring that bell so you're always in the loop. See you in the next video.